was a great start to this evening's discussion. I'm Emma Howard-Boyd and I work at Jupiter Asset Management, where I spend a lot of time meeting with chief executives, chief finance officers, chairmen and other non-execs of listed companies in the UK, talking about long-term issues, talking about environmental, social and governance issues. And very often in those meetings, particularly post-results meetings when the CFO is in attendance, it's not often that we get the chance to focus in on some of the agenda that John has discussed tonight. So I'm going to introduce the other panellists. So if I start off, and you've got bios in your pack, so I'm not going to go into a huge amount of detail. We've got Nick from Pret A Manger. When we asked him to join the panel, he was indeed CFO, but has now moved into the Chief Operating Officer role, but also has responsibility for sustainability. So I think can talk about Pret's involvement in this agenda, not only from a CFO perspective, but from that broader context. Richard Meddings, who is Group Finance Director of Standard Chartered, and we're delighted that we have a representative from the banking sector here tonight, because as we've already touched on, or John's already touched on, the whole values debate is very relevant, not only for the banking sector, for financial services as a whole. So it's great to hear some of Richard's perspective on this whole area, and particularly delighted that he's here because Richard chairs Seeing is Believing, which is one of Standard Chartered's flagship projects. I've been to a number of events that Standard Chartered has hosted, and Richard has done a lot of personal fundraising for this initiative. And Standard Chartered has committed to raise $100 million, is that correct, by 2020?
115, I think.
Right, so it increases every time I hear about it, to combat avoidable blindness across the developing world, so very relevant to the region in which Standard Chartered operates. And Claire, not last but not least, who is CFO of BT Technology Services and Operations. And I think when it comes to some of the no-brainer slides that John showed us, energy, carbon in particular, something that BT has a very strong reputation for, absolutely fits into Claire's remit. So we have roughly 25 minutes, 30 minutes for a discussion up here. Then I'm going to open out to questions from the floor. So I do hope that what you've heard already will inspire some great questions to our CFOs. We've talked about trust, so I'm going to start, Richard, with you. Particularly, it's so relevant to financial services. Some of us may have heard Anthony Jenkins, CEO of Barclays, guest edit the Today programme over, I think it was New Year's Eve or New Year's Day, and he talked about it taking 10 years for the sector to get back into a position of trust. I'd really welcome your perspectives, particularly as a finance director, on this whole rebuilding trust agenda.
So I think what Anthony said is, I don't know if he's right in terms of the time frame, but it's clearly a longer time frame. It's 5 to 10 years, but it's not a year for the banking industry to rebuild trust. The trust of the public at large, either as customers or observers, and that public is either retail or actually in many cases the smaller businesses. Less the larger corporates, I think, but the smaller businesses. And it's quite clear that over the past recent years, a number of the practices in the banking industry have, frankly, been quite shameful. And for that reason, we go to the point of trust. It's very easy for any corporate to lose trust. And that might, I think, come up in broader conversation. One of the thoughts as a CFO one has about, can you prove the positive case for a sustainability or a set of values? Actually, one of the ways to prove the positive case is to go the opposite and talk about actually what happens if actually we don't do this properly. What is the negative impact upon the business, upon the industry, on people's ability to deal with you? And it goes broader than the public, clearly. It goes to regulators and supervisors and relationships with governments and relationships with potential employees, graduates we wish to hire, the future of the industry, how many people want to come into an industry which is so attacked, in many cases deservedly, not in all cases, in many cases deservedly attacked as an industry, how many graduates we want to go into that. So I think Anthony was absolutely right, that there's been a significant damage done by the industry to its own perception across a range of constituencies. and it will take, I think, a substantial time for that to come back. It's going to be a cycle. It's going to take a long time, partly driven by the economy itself. Until the economy recovers, truly recovers, I think actually the pressures that people are feeling through austerity and the rest of it does keep coming back and goes to the financial sector, not just the banks, the pressure of the financial sector. So part of the rebuilding of trust, I think, also depends upon economic recovery predominantly here. We're talking in the UK, but generally in the West. I would say Standard Chartered, most of our businesses are in Africa, Asia and the Middle East. You don't see the same loss of trust at all for the banking industry the further east you go. It's very much a Western phenomenon, but it's also mainly because many of the more difficult practices, shameful practices that have emerged are predominantly actually Western, and they are not actually as evident in Asia or Africa or the Middle East. And therefore I think that overall perception and loss of trust for the industry is less evident in our markets than it is here in the UK or in Europe or in America.
Thank you, Richard. Claire, you've got carbon and energy very clearly in your area of remit. Would you like to tell us, so that from my perspective fits into the no-brainer category, but would you like to tell us a little bit about that, why it's important to you, but also where does trust fit for BT?
Well, just on the carbon area, BT consumes almost 1% of the UK's total electricity. So with that's quite a big number, and with rising energy prices and a bit like I think John was talking about within Sainsbury's, rising consumption, it was clearly something that we had to address. And we are sort of three to 4 years in our programme. We've taken £100 million worth of annualised sort of cost out of that area. That's great from a cost perspective, but I think it also has reduced our carbon footprint or our carbon emissions, and that's really, really important for BT. So it's a journey we've been on, and it's one that I guess we will very much continue on. Like these guys have talked about the 2020 ambitions, BT also has some real sort of targets for 2020, and carbon emissions across the end-to-end cycle is really important for us and how we reduce that for our customers. And I think having a responsible business that is building a better future enables BT to create, I suppose, that trust in the brand of BT.
Nick, some comments from you, particularly having recently changed your role, and looking at that perspective of the role of the CFO. How key is it to this agenda? Has it been a blocker? Is it now an enabler?
Well, I was the finance director when I was in charge of sustainability, and I think that helped. It helped because finance directors typically are well organised, so they make sure there's a clear strategy, they make sure things are done, so that helped. And then if you imagine this as a board and say you're the CEO and I'm the CFO, the other three are unlikely to challenge sustainability if the finance director's arguing it for you. So you don't get all these silliness about, well, can you prove it makes sense, can you prove it adds value? Because the person who'd asked those questions is the CFO, and it's the CFO proposing it, and CFO saying, well, I want to spend £250,000 here, I want to give £400,000 to charity, I want to start an apprenticeship scheme for young offenders, and if the CFO is saying it, no one tends to argue. So that is useful. That's a key advantage. And the other thing is, the most important thing is it's the most interested person. So if you're the one that's committed to it, obviously you see, I'm sitting next to Richard and you can see the wristbands on his wrist. This seeing and believing is obviously something he's committed to. He's driving that through his company. Same for me in sustainability, something I'm committed to. So if you're personally committed, you can really add emotional power to it as well, and that's important, even with colleagues, because if they can see that this is something that really matters to you, they're more likely to support you. Having said that, in Pret it's very much, very easy to do, because doing the right thing just seems to be the right thing to do. It just seems obvious. We make sandwiches every day fresh in our shops. We do that every day, so at the end of the day, we've got product that we're going to throw in the bin. Well, why would you throw it in the bin when you can give it to hungry people? We take a lot of people on every year. We've got jobs. Why wouldn't we set up an apprenticeship scheme for young homeless people and young offenders and give them a chance to have these jobs? Why wouldn't you do that? Those are the things so we can do. We've got food, so we can give that away. We've got money, so we can give some of that away to homeless charities. We've got jobs. Let's give some of those to people who otherwise wouldn't get jobs. So I think it just seems to make sense to us. Just do the right thing, and it's not about saying it's good for business. It's just because it is the right thing. There's no further argument than that. You know, you're a person. You have personal ethics. You can't leave those ethics behind just because you're in business and say, well, now I've got this false god shareholder value. You know, I couldn't possibly do anything to help anybody out because of shareholder value. You've got more than one stakeholder. You've got your staff, you've got your customers, and you've got your shareholders, and you have to keep the balance right between all of them. Charge too higher prices, you won't have any customers. You might have higher profit, but it won't last for long. Don't pay your staff enough, you'll have unhappy staff, you won't get the sales. You've got to get the balance between the three. Not make enough return, and you won't have any money to invest. So it's balancing the three that's important. It just seems self-evident, really.
So John, do you want to make any comments on what you've heard from your colleagues?
No, I mean, I think the points you've made there in terms of getting the balance right. I mean, I think sometimes businesses, you know, put too much emphasis on trying to substantiate and create a case for investment when, in reality, sometimes that case is almost impossible to create. But also, to your point, actually, it is about just doing the right thing. Sometimes doing the right, you know, I think. Sometimes, you know, we hide behind the vanilla of a corporate where we believe, as I say, we're a slave to creating shareholder value. I think corporates are not just about creating shareholder value. As you said, they're about balancing the needs of all different stakeholders, and they're not always in contradiction. I think one of the things, and it's maybe a debate that we can come on to, is to some of your opening comments about investors.
Yeah, well, I was going to come on to that, so carry on.
And you know, to me, what I found quite interesting is we found it really difficult to get any real traction behind this idea of having a sustainable business model underpinned by values with investors. I think they sort of get it, but it's not something that investors ever really focus on. And I've said this to you before, in 4 or 5 years of being a CFO, I've only ever attended one investor meeting where the issue of sustainability specifically has ever been raised. And yet we know that customers, the end consumers, absolutely get this and care about these issues. And at the end of the day, you know, generally speaking, investors are investing the money of pension schemes the pension schemes of these very same consumers who care about these issues. But there seems to be sometimes a blockage that's created, either with corporates or indeed with investors, that somehow they need to act differently. You know, they have a responsibility to deliver returns, or responsibility to deliver shareholder value, and yet not necessarily support the underpinning interests of those members that in a way they're representing. So indeed the individual pension scheme members themselves. I think that's something that, you know, probably is worth exploring and talking about.
Yeah, and I think certainly one of the areas at the CFO network that you're involved with Accounting for Sustainability is going to focus on how to change engagement with investors. I know, Richard, you certainly have some views on this. Claire, I don't know whether you want to, as a member of a listed company, want to express some views. But it certainly, for someone who spent the last almost 20 years in this area, still absolutely disheartens me when I hear that there aren't enough questions being asked of CEOs and CFOs around this agenda.
I was just going to say something that's unusual, I think, because 2/3 of our business is owned by a private equity business, and the common perception of private equity businesses is they wouldn't be in favour of any of this activity, and it's just not the case. We don't have any of this, now, and I'm sure they're not all alike, but we don't have any of this pressure about not doing things. It's all about long-term value. It's all about how much you invest. It's all about having value. So it's quite interesting. And I'm listening to what John and the others are saying about this short-term pressure. And that's something, actually, the fact that we have longer-term investors does give us the freedom to express our values, I think, in a way that perhaps isn't so easy if you're having to do quarterly reports, quarterly forecasts, and improve your earnings per share every 3 months.
Well, I think that's right. I mean, I'm here at Standard Chartered. I'm also on the SID, or on the board of 3i, and I'd echo that comment with regard to 3i's focus on sustainability and longer-term investment. And in particular, actually looking at the area of sustainability, and it's an area that the board of 3i looks at with the investment professionals pretty much at every meeting. On the investment market more broadly, I have had more than one meeting, but it's not many meetings, where the questions of sustainability come up with the investment institutions. I agree with John, therefore, it's a very rare area of investigation by them. And I think it goes to what Nick just said in terms of short-termism. There was a very interesting report, I think, by John Kay a year or so ago. I get the timing quite wrong, asked to look at short-termism, in particularly in investment institutions in the city. I think as the markets have moved over the last few years, and these institutions, many of them often just labelled as the hedge funds, it's not only the hedge funds, it's not even all of the hedge funds, but there's a larger proportion of investors in the market who have very, very short-term horizons. They will be concerned about sustainability issues because they will not want to make an investment and find then actually that there's some major issue blows up in this area. So the horse meat scandal, for instance, would have caused them significant nervousness. That loss of trust would also have replicated through to share price performance. So they're concerned to understand, is there a risk profile here? But candidly, they're in and out much shorter term. When I started a long, long, long time ago in this business, I was always taught that what the stock market was a source of long-term investment. It was where you went for investment in companies. You brought companies to the market to source a new shareholder base. It's completely changed over the last 30 years. And it's changed now. And with that, I suppose, a slightly glib comment, it does feel more like being a casino chip on a table, often engaged with many of the investors who are in and out within 1 month, 2 months, 3 months, will short stock, not as much as, but they will short the stock as much as they will go long and buy and hold the stock as a long-term investment. So you've basically got a real divergence in the way many institutions who buy shares actually think about the tenor of their holding, and it will absolutely change how they focus on this issue. We say in and out shorter. It doesn't mean they won't come back in 3 months' time or 4 months' time, but their trading period, their horizon, is a much shorter one than the issues we're talking about here in sustainability. And then lastly, if I can, I didn't say it was the nature of your question. When I'm asked about sustainability for Standard Chartered, the fundamental point for us and for a bank is to be a good bank. I'm sure it's the same for the other businesses. It's to do the business you do and do it well. And that is the key, I think, to whether it's values or sustainability or the views we take, whether it's integrity of sourcing or whatever aspect. It's, in Standard Chartered's case, it is to be a good bank in the communities all across the world that we serve. And that's the key underpin to everything we think about.
So do we have to ignore this, the question of the investor, and do you as companies with your boards just carry on with these programs because they are absolutely fundamental to your business? Claire?
I think from our perspective and from my view, I think it is absolutely critical that sustainability has to be on the agenda. And it's back to kind of the comments that we were saying earlier. It's about doing the right thing, and sustainability is about doing the right thing. And whether investors have short-term views or long-term views, they just want us as CFOs, CEOs, boards to do the right thing. And whether you can sort of monetize it or whether you can measure it, it is about cracking on and doing that. So I therefore think that as CFOs, boards, whatever, we need to continue to do the right thing. And as we go through time, I think we play a really big role in educating that investor community. I'm not saying it's easy, I'm not saying we'll change their mind, but I do think they need to understand that it is part of doing the right thing for a sustainable business. But I do accept that they do have a short-term view.
But customers can help, can't they?
The
So the
customer-
stock market
Sure.
can be something that doesn't help, but customers can help. They can sort of say, well, I don't understand why I have to pay my tax. I don't understand why you think you shouldn't. And those kind of things, a customer can act as a good force to support.
Yeah.
I think for a retail business that's very apparent because we know that customers care about these things, and therefore if we do things that customers care about, in the end that's good for the business, good for sales, and it's good for shareholders. I mean, I think sustainability, having a sustainable business model, not only is the right thing to do, but I think you can demonstrate that it is a point of competitive advantage in today's market. I think you can demonstrate that it does create and add shareholder value. I think we believe wholeheartedly that the quote that I put up from the Guardian journalist, I think some investors are starting to recognise these things. They are starting to understand that it's not just about short-termism. It is about creating a long-term sustainable model which financially actually will hold the business in good stead. It is the right thing to do, but equally financially it makes good commercial sense too. And I think there is a bit of a tipping point or a change in perspective. I think it's taken a long time to get there, but I think some investors are at least starting to put these thoughts on their agenda.
Well, I think that's good to hear. I think there's some investors in the audience, so we may hear from them, because I know I'm not alone to being someone who champions this agenda when out meeting companies, but we're probably still too few and far between. I think many people in the audience would be interested about the point you made, John, about not always needing the business case, and so that judgment is needed, because often people are challenged to really make sure that what you're putting forward to your executive committee meets the financial imperative too. So what can you say to encourage individuals in this room to take a different approach as to why it's not just the economics that make a particular project a no-brainer?
I mean, I think you just have to highlight that, again, what I was trying to demonstrate in the 3 examples that I talked through is that, as I said, in the example of taking sort of colleague engagement into account, nobody would debate the point that actually having engaged colleagues is a good thing for the business. But, it is quite, I challenge any of you here to create a commercially robust case for why you do so. There are so many externalities, there are so many points of subjectivity that actually creating a commercial case for doing so is actually quite tenuous and quite a fatuous exercise. And yet we all recognise here that having engaged colleagues is the right thing to do. As I said, to me, I think it's quite an interesting question for society as to why it is that when we're talking about issues of sustainability, this perceived, hurdle for decision making, I think is somehow placed artificially higher than we place the hurdle for broader decision making within our businesses. Issues that not relating to sustainability. There's something there that the challenge is always made in relation to sustainability, and yet never do we debate colleague engagement or other things that clearly have a very strong commercial backing. And I don't really sort of quite clearly know why that should be the case. I mean, most decisions, as I said, that businesses take, it's a combination of having some financial numbers that support the taking of that decision, but very often there are other externalities, other issues, other factors at play that in the round make it the right commercial decision, not necessarily supported purely by the numbers.
Any other comments, Nick?
I think it's the emotional case that really leads the way on this. I mean, we had a girl who used to sell the big issue. She had a chaotic drug-involved life, and she used to sell a big issue in front of one of our shops. And one of our managers, Murad, went out and invited this girl to come and work for Pret, and he invited her and again. And she couldn't believe anyone was bothered about it, but eventually she came and worked for us. Now, she came and then spoke at our conference, and that, when you see someone who's had a chaotic life and then something worthwhile's happening, then all disagreement with investing money in, say, the apprenticeship scheme disappears. So I think you've got to use the right people, and so if you get people whose lives you've helped to alter and get them to speak about what's happened, then I think even the most hard-hearted person says, well, that seems to be a worthwhile thing to do. And I think.
And Richard, how do you look at these issues, particularly if you're making a challenging commercial decision as to whether to lend money to a good business or a bad business? I'm thinking of some of the climate change agenda, some of the fossil fuel industries. How do you work through some of these issues as
So first of all, we're very structured. So I think there are 20 policy statements which deal with everything from tobacco to shipbreaking to nuclear power, through retail, through water. So how do we engage in lending to projects and programs across these areas? In terms of lending to bad businesses, we wouldn't. It counts of what you define as bad, but lending to bad businesses, we wouldn't. And by that I mean businesses which are unable to demonstrate that they are, first of all, financially able to repay the loan, and I'll come back to that if I might, or alternatively, they're unable to demonstrate to us their proper provenance, by which I mean, can they do KYC and AML and so on appropriately, and the bar on that has clearly gone up very, very significantly. Why would we not lend to bad businesses on the judgment they couldn't repay us? Because banks are very leveraged. And so what it means, if you assume that I have got a leverage ratio of 30 times, it basically means that I've leveraged my capital 30 times. I've lent it out 30 times. And if you think that, and you then think, well, actually, one of those loans goes bad, and I lose $1 of loan, that $1 comes out of the capital, and to maintain my same ratio, which I have to do for regulatory purposes, it means I've got to take back another $29 of good loans. So actually, making loans to companies that can service, or people that can service and pay those, is actually a very, very important judgment. I agree absolutely with what John says. You can make financial decisions and you can adjust them with sensitivities and scenarios to essentially prove that on the balance of probabilities, it's a good investment. It's about judgment. It's about commitment and judgment. And there's a lot of soft stuff in here. So we do things like, we've lent $1 billion to microfinance institutions. We've lent $10 billion, just under $10 billion, to clean energy. We have just committed last year to increasing our SME lending by 45% over the next 3 years. And that was to the Clinton Global Initiative. There's a series of things we do here. Why do we do them? One was we do that type of business. But in terms of how we set the target level we're going to go to, there's a huge amount of judgment in that. We do lots of tests. So there's something called the social accounting matrix. The World Bank and the IMF use it. They test how a bank contributes, or we contribute to particular countries. So we've run that in Bangladesh, in Indonesia, in Nigeria, in Zambia, in Kenya, in Ghana. And we look at what Standard Chartered's contribution is to the GDP of each of those countries, looking at lending and trade and agricultural production and so on. And that's a measure used by the World Bank. So there's a whole series of techniques we would use. But in the end, it just comes back, I think, to soft issues. And if I can very quickly finish it. So seeing is believing, because I do care about that. I've chaired it very much. I've chaired it for 8 years. We started seeing is believing 10 years ago. Idea from a member of staff, how to celebrate our 150th anniversary of our foundation. And a member of staff said, why do we raise enough money to cure cataract for 28,000 people, then the number of people the bank employed? We now employ 90,000, 89,000 people. And we did that really quite easily. We found a real reservoir of support amongst the staff who donated and did cake bakes and sponsored walks and cycle rides. And we said, this is amazing. And we went for another target, and we've gone every year raising the target. And what did we find? What we actually found, which we didn't expect to find, were two things. One, graduates who wanted to join the bank, in their top 2 or 3 factors put as to why they wanted to join Standard Chartered was a reference to seeing is believing, or HIV/AIDS, or malaria in Africa, but seeing is believing was very, very strong. And the second really odd thing was it provides an invisible and intangible cultural cement in an organisation which operates across 70 different countries, very, very diversified. And 75%, I think, of the funding is raised by Standard Chartered staff. And whenever you go to countries, there are activities going on, and it's an invisible cultural cement to the way the company operates, which has 154 nationalities, very different ethnic mix, very different geographical locations, and it's something that binds the group. It's very interesting. Now, we didn't expect that. It was simply, what do we do to celebrate our 150th anniversary? I know we'll fund cataract operations for 28,000 people. And today, we've funded cataract operations for 2.8 million people, so 100 times more than the original target we had. It's been quite remarkable.
Well, that's a fantastic story. I'm going to ask one more question and then open up to the panel. So it's really about future scanning, and what do you think, as CFOs, are going to be the issue that you're going to have to grapple with next from the sustainability agenda? Who'd like to go first? Claire, would you like to?
Well, I think there's many issues, and it's quite a complete agenda, actually, and quite a full agenda. I think from my perspective, I think for us as CFOs, and certainly for me as a CFO, across BT, I think our leadership is very passionate about sustainability, and I think it's a belief set, and I think as a CFO, if you don't believe it, and therefore be it a no-brainer decision or you make the decision based on judgment. I think as CFOs we have to have that leadership to make it a belief for everybody in our organisation, which I think therefore allows you to address the balance of shareholder, customer and employee. And I think as CFOs we play a huge part because, you know, as you were saying earlier, the minute the CFO says, yeah, I believe in that, nobody's necessarily going to question. So I think that's really important. We as a company, you know, it is about doing the right thing, and it is about trying to measure that, you know, if we do make an investment, and you might make it on judgment, it is also important to ensure that, you know, on a post-evaluation that you're delivering the right output and you are delivering the sustainability. And I think as CFOs, we need to ensure that we can, and it's not a measurement per se, because I think all of this is around judgment, but we need to ensure that we are driving the agenda. And I think as CFOs, we need to keep our businesses honest to that. So I totally accept that you may make decisions on judgment without the hard fact, but I think post that you've got to know that it is changing your business and it is changing the future outside that. So I think there's a lot on our agenda. Clearly, I will continue to stay awake at night as I consume 1% of the UK's electricity, you know, so that will definitely be something that I'll have to continue to do. But I think it's just about all the different issues across, you know, and for us as BT, it's kind of, you know, how do we connect society? How by 2020 do we have 9 out of 10 people in the UK completely connected? How do we improve the lives of people? And how do we drive sort of the net good for the world around the end-to-end sort of carbon emission cycle? And there are certainly some really key areas that we're focused on as business, and clearly they'll be top of my agenda as I move forward. But I suspect every business has different sort of issues that they're grappling with as they move forward.
Well, I mean, tax has been a big one. That's interesting. That's good. Animal welfare in retail businesses, very important. I think the next big thing is fair wages. So living wages for people, ensuring people are paid properly. So we increased our team member pay in April. We increased it again in October. We'll increase it again in January. We're already very much ahead of the minimum wage. And you know, the living wage and things like that are important agenda points for us. And more companies making a breakthrough in that arena will be vital. I mean, making sure people have, you know, people who are working hard are paid properly is a very important thing, because otherwise society it starts to fall apart. If people work hard and still can't afford to support themselves, that doesn't seem appropriate. So trying to ensure that we increase the wages of our people at the bottom of the pile as quickly as we can is very important to us. And then obviously the nice thing about Pret is the people who run the company, not me, but the people who run the operations of the business tend to have started on the shop floor. So people get promoted quickly, so get more pay. But making sure even at the bottom level the pay is of an appropriate level is very important to us. We hopefully do it already, but doing more on that is our most important issue.
Richard.
I think for us it's, I mean, a whole range of issues like everyone has said. Many of our markets are seeing very strong growth in underlying demographics. They're seeing very strong growth in underlying GDP and wealth creation, emerging affluence. So as a bank operating in those markets is about providing good financial services, good lending to emerging SMEs, good lending to corporates, good intermediation to capital markets, good risk management products in derivatives. So how do we do that job and do it well? In the UK, we're very focused, although we don't have a sizable business here. We only employ about 2,000 people in the UK. We're very concerned about youth unemployment, which was mentioned right at the start, actually. I think the other areas, fair tax, this idea of fair and tax for all international corporates is an emerging and interesting challenge that's going to come. In our case, we paid just over $12 billion of corporation tax, just corporation tax, in the last 10 years, which is an average rate of about 28%. And that's the cash paid over that period. And if you think that we have markets like Hong Kong and Singapore where the tax rate is 13 to 17%, you can understand that paying at 28% also includes the fact we're the largest corporate taxpayer in India. But the whole question of what is a fair tax payment, I think, is going to be something that the corporate world is going to have to grapple with over the next 3, 4, 5 years, and then for however long that issue runs.
Yeah, I mean, I think many of the issues already covered by my other colleagues on the panel, but I think one particular for Sainsbury's, and it very much I think probably a sort of 15 to 20 year issue, is in relation to the security of our global supply chain. particularly when it comes down to sourcing food, and that the whole sort of global agricultural economy is changing. The demands placed on that, particularly by growing economies, of course, like China and India, are placing huge amounts of pressure on the ability for the globe to generate and sustain and produce product. And so, taking a very small example, but if you look back a few years, I think it was 2008, you couldn't source basmati rice because India had put an export block on basmati rice, very good reasons to feed its growing population, and Thailand equally for similar reasons. And so we were able at the time to source it through contacts with Italy, but because we'd built up these relationships with these suppliers over many, many years, that meant that we were able to supply our customers with basmati rice. Now, that's one small example. But these sorts of challenges we're going to see increasing in their nature over the next 5, 10, 20 years as the growing demand for food production increases, as I say, particularly from the BRIC economies as they grow going forwards.
Well, that's fantastic. I think that shows you the range of issues that our CFOs here tonight are thinking